bring Matt Swieconek to the front of the room. Now in terms of the sessions we've had, we had a session up front where Patrick spoke about serving sort of that middle market between mass affluent and high net worth. We then had a panel session about high net worth needs, and we've now just gone into the very differences that are definitely there for the family office market. The idea of this session is to talk a bit more about how to kind of orchestrate a business in this market. So maybe, Matt, if you could kick off a bit with probably Findex's origin story, but how you've been involved with them to evolve and scale things over time.
Sure.
Whilst I get my note.
Yeah, no worries. And I'm not sure which social circles you're running in for family office referrals off to Michael's, but I might have to talk to you about that. So, look, I'm not sure if many of you know about the Findex business. There are some here who will and some who don't. The business has been in operation for, believe it or not, 36 odd years. But it's flown under the radar for probably 35 of those. It's not a very well-known business. We are a business that's firmly had its roots in financial planning since the very beginning. So our founders, Spiro and Terry Paul, formerly with Associated Planners back in the 80s, and formed Findex in 1987. And it was a business really to serve the mass affluent market, mum and dad Australia. And interestingly enough, the whole idea around calling it Findex back in the day, it was Financial Index was our original name. It had nothing to do with a financial industry. It was all about someday building out an index of financial services for clients. So from those very early origins, where it was just financial planning, the objective was always to have something much bigger than that as far as service offerings are concerned. So fast forward to 2014-ish. Throughout that entire duration of time, our business, as I mentioned, had always been one that had focused primarily on the mass affluent market, had grown significantly via acquisition. I came to the business in 2006 as part of an acquisition. I was with a Futuro practice in Canterbury and Melbourne at that stage, had been for 5 or 6 years, and I was part of the acquisition. The practice principal left, and I took on that business, and that was our Canterbury branch of the Findex business, which at that stage had about 60 staff. So it was a very small operation indeed, but with big aspirations for M&A growth over a period of time. So I think since my journey back then in 2006, I've been involved, I'm going to say, in 36 different acquisitions, but when you open the bonnet and you have a look at all of the different businesses that those businesses have under the bonnet, there's somewhere in the order of about 150 odd businesses that have rolled up to form Findex as we know today. So why am I sitting here in terms of talking about serving high net worth clients when I've said that we've traditionally been a mum and dad retail-based business? In 2014, as part of our acquisition process, we bought a business by the name of Centric Wealth. Centric Wealth was a business that was almost entirely targeted towards the high net worth and ultra high net worth market. So our business client composition changed dramatically as a result of that particular acquisition. I believe there was about 36 suitors on the list. We weren't even on it there at one stage, but through some, it's always a case of not what you know, it's who you know. And thankfully our executive knew some people. We got on the list and subsequently were successful in buying the Centric Wealth business, and that was a bit of a game changer for us. Fast forward 12 months from there, we acquired a business by the name of Crowe Horwath, WHK Crowe Horwath. So going from a financial planning business with 60 staff or 100 staff to having 300 staff post-Centric Wealth, we went to 3,000 staff in 2015, and no longer were we just financial planning, wealth management. We were now primarily accounting and tax services and audit and everything that goes with it. So 80% of our revenue is accounting based and 20% is wealth, but it is the vastly more profitable component of the profit and loss. So as a consequence of those two acquisitions in particular, our client base really did start to, or our focus really started to tilt towards that high net worth and ultra high net worth market. And that's really something that we've continued to grow out today. And I guess one of the unique selling propositions of what we offer into that market comes down to what I was speaking about a bit in the room earlier on, is our investment proposition, which is around the managed discretionary account and what that offers to all and sundry, all the way through from our grassroots mum and dad clients all the way through to our ultra high net worth clients. It's got something for everybody, and it's certainly something that really fulfills that segment quite nicely.
Do you want to talk a bit about perhaps how big things are now beyond the 3,000 staff? So how many, maybe some fast facts around how many advisors, how many clients, how much is in the MDA? And then we might talk through then how does that get organised sort of regionally?
Sure. So we have, as I said, 3,000 staff, 110 of those are client-facing financial advisors across 100 plus locations throughout Australia and New Zealand. So we look after in totality around 17 billion in investable assets. Now 9 and a bit of that will sit on the MDA across 11,500 client accounts. So it's a substantial, I believe it's the largest managed discretionary account in the country. So Toby's given me the thumbs up, so it's been endorsed. So it's a serious operation that we have, and it's something that we invest in heavily. Now, prior to the last few years, it's not something that we've been out there in the market actively promoting. We've always run on the basis that it's best to fly under the radar with this sort of stuff. But we are now, we see it as the jewel in our crown in terms of our offering out there into the marketplace. It really is a unique offering in terms of the size of it. We've got, as I mentioned earlier on, we've got a full internal research capability that conducts all of our internal research.
How big is that? Just
we've got a team of 8 analysts. That's headed by Kieran Canavan, who was in the room earlier on. So he's our CIO. So 8 analysts. We also have extensions of that with groups that we work with, both onshore and offshore for specific mandates. So talking about alternative assets beforehand, alternatives is a segment that we've really jumped headlong into over the last 2 to 3 years, probably longer than that now, probably 5 years. And it's an interesting one because all of our portfolios are almost entirely liquid. Our most illiquid assets, even in the alternative space, would be monthly unit priced. So we've not, and because of its very nature, the MDA is rebalanced on a regular basis. So it's not the type of structure that lends itself to lock-up periods or unlisted assets. That's not to say we don't have clients who have those, but it's not something that we would look to introduce at this stage into the MDA.
You've got a fair bit of adherence to the managed account or MDA process. Perhaps in the room you work in practices where everyone does the same thing and they all agree. Perhaps that's the case, but that's not always the case. What was the process you had to go through to get, let's call it a bit more adoption and a bit more of a house view so that Findex could deliver consistent outcomes to more clients?
Yep, it's a really good question. And it's one that when you're starting on your journey, it's really important to give consideration as to how you're going to plan out the transition, because it's not something that just happens overnight. People just don't conform if that's not their value proposition. Now, we were fortunate as a business at Findex. We had always been a business that had adopted a model portfolio style approach. We used to use Masterclass back in the day, and that was the way that we ran multi-asset portfolios. But as I mentioned, it wasn't until the Centric Wealth acquisition that we moved into that MDA environment, and that became, it was a very close synergy, I guess is what I'm saying, between our philosophy prior to that acquisition and then the Centric Wealth acquisition. If you fast forward that next 12 months, when we acquired the Crowe Horwath business, that was very much, albeit it was a publicly listed company, it was very disparate in terms of its investment philosophy. We had offices across the board offering very, very different investment philosophies. They were pricing very differently. Some were passive based, some were active, some were using investment committees, some were using different models. So there was a very wide, broad spectrum of investment philosophies in use, and a lot of advisors saw themselves or their value proposition as the fund manager. They were the investment advisor. So all of a sudden Findex comes along, and we've got a mission to change all of that because, as you know, Mark, we've got a very strong one best way policy. And so it is very important for us that, particularly with a business of that geographical size, that we have conformity and consistency across the board. So I won't lie and say that it happened in 12 months. It took successive years for us to get to a point whereby we were able to educate, and we essentially strapped ourselves to the side of an aircraft for the best part of 2 or 3 years, visiting all of the different geographical locations that exist within the network. And it was really a case of things I mentioned in there beforehand as well, having a very strong value proposition, articulating that, and having belief in it, really believing in what we were delivering was the best outcome for clients. Some advisors along the journey weren't of that belief and fell by the wayside. Very good advisors too, but their value proposition was different from what we were wanting to deliver as a business. And so therefore for us it was a case of, well, that is the way it needs to be for us to get to our objective.
Any questions from the audience? Andrew, just grab the microphone. Andrew.
How did you manage to bring the advisors who were the suburban Warren Buffetts, the portfolio managers themselves, how did you manage to engage those guys and get them on that journey with you?
Yep. Time, education, client briefings. It wasn't something that the majority would turn around very quickly. So there was an education period, a gestation period, if you will, trying not to force people into something that they weren't. We made it very clear, if this is not for you after you've heard, give it some time, give it 6 months, give it 12 months. Have a look at the machinery and how it operates, and see how it can benefit your clients, because we truly hand on heart believe that this is in the best interest of your clients. And if after that period of time you still don't have that form of belief, well then perhaps we're not the best company.
Because sometimes in big institutions they've got these set up and performance is terrible compared to what's on the market, and you know, advisors are chomping at the bit to, you know, do direct equities or do other things.
I do know these guys reasonably well. Do you want to add to how you track? You can track performance in class, which can allow the do-it-yourselfers to get benchmarked against your portfolios.
We do. So all of our data feeds into Class and various software programs, so you can track that. But the performance issue was an issue initially. So, but we never ever sold it just on a performance basis. We know that managed accounts, MDAs, SMAs, IMAs, they offer so much more than just potential outperformance, right? So there's the ability for you as the advisor to free up the time in your day that you would otherwise be spending preparing advice documentation, which we all know about. And yes, as a byproduct, over time, our research capability and our management of those portfolios has shown to outperform what the advisors would themselves have delivered to their clients, because typically they've been tilted and heavily tilted primarily towards Aussie equities a lot of the time. And so what we have really spent a lot of time doing is introducing some, for want of a better term, capital protection mechanisms like alternative assets, which act as a bit of a cushion in down markets. So it's not just about the upside, but also if you consider our client base is very much in that 60 to 65 plus age bracket. These are people who will forgive you for missing a few points on the upside, but not as much if you're losing more on the downside. So ours is just as much about protecting on the downside as it is getting the performance.
You've got 110 odd advisors. You've managed the succession. Let's call it the succession planning of more senior advisors internally. How have you managed that and still sort of held on to the client base over time?
Another good question. We've got a lot of long-standing advisors that have been with our business, and Brett, Gary Lofhagen's and the Paul Crowns of this world, Greg Pride. Greg Pride has still his first client who he brought into the business 38 years ago. So we've got clients with extremely long-standing relationships with our business, but they also are very connected to their advisors. Thankfully, our advisors who have left have typically been due to retirement. There have been all manner of reasons as to why people have left. But once we understand somebody's time frame for departure from a business, we'll typically always have a primary and a secondary advisor in a client relationship in any case. Okay, so there's always that continuity with the advisor. But if we know we've got a retirement situation, for example, and we did this with Gary Lofhagen, the fellow I mentioned beforehand, we knew 18 months out that Gary was going to retire. We started the transition process from the day he told us that he was looking at exiting the business, and we went through a series of handover meetings. We managed those meetings formally on a monthly basis. They're all minuted. We what do you call it, traffic light colour any risks that might exist within that portfolio of clients, so that we know if it's a red or an amber. We've got some work to do there from a risk perspective. But I guess the bottom line is there that we measure it and we track it all the way through, and we've got somebody there who's riding shotgun with the advisor, who typically then takes on a lot of those relationships from a continuity perspective, because they've been dealing with the clients for a long period of time.
Toby.
You mentioned in the session earlier on today, Matt, all your advisors are salaried.
Sure.
Do you want to talk a little about, as far as you feel comfortable, the sort of the way you remunerate advisors to keep them on board, compared to the pull the pin, set up on their own?
Yeah, sure. So base salary plus STI and LTI, so short-term incentive bonuses, and in some instances long-term incentives, which is equity in the business. I think Kieran might have mentioned it. 90% of our partner group within our business hold equity in Findex, so there's a vested interest there for them to participate in the commercial success of the business. We're not on a grid system or anything of that nature, so it is a base salary which is pegged to what's out there in the marketplace. Every year, our People and Culture division do a market benchmarking exercise out there in the market, and they'll come back to us with salary bandings for all of our level of advisors. So we know exactly what's happening out there in the market and where people fit relative to the market. And our incentives are balanced scorecard. We all know the phrasing, and there's a multitude of different KPIs that our advisors need to achieve, both on a commercial growth sense, but also around compliance, client service, and so on and so forth, for them to be eligible.
Can I dig into that? Look, I'm a big fan of measurement, but I'm also a big fan of when you measure customer satisfaction. So for each advisor in that balanced scorecard, they have some sort of customer satisfaction measure?
Yep, NPS. So every client who has a review in our business is sent an NPS questionnaire to rate the advisor. And so it's something that's a universal scoring system, but that also feeds into the balanced scorecard for incentive purposes.
Okay. Question out the back. Grab the microphone from Toby.
Congratulations on growing your MDA. So obviously there are incentives, or there's a framework for your advisors to actually funnel money into there. What is that framework, and how do you manage conflicts around that?
Sorry, there are incentives for putting clients into the MDA, did you say? No. So the advice flow, so advisors are bound by best interest. So if they have a conversation with a client, so we've got two approaches. We've got the collaborative, or we've got the discretionary approach. Our advisors they are required to have a conversation around both of those methodologies with every client. So not every single one of our clients, I should have made that clear earlier on, not everyone just walks through and that's just not something that we're able to do. So we are very, from the very first point of induction with an advisor, we make it very clear there has to be the offer of the collaborative approach with the client and the discretionary. You must make both available to the client, make them aware of it. We find that 8 times out of 10, the discretionary system works or happens, And over a period of 12 to 24 months, those that don't typically gravitate towards that. Yeah.
Maybe one of the last questions, you could talk to your client advisory group. That's quite a unique thing that I find Findex do.
Yeah. So again, that was an initiative that really came with the Centric Wealth acquisition, and it's no more scientific than bringing clients of ours, influential clients, into our boardroom and having an audience with our executive on company initiatives and giving us feedback on those company initiatives before they are then subsequently rolled out or not rolled out, if that's the case. So in a number of different locations across the country, every 6 months, we will have a boardroom client advisory group or CAG meeting that's chaired by an independent chair by the name of Dr. Joe Collins, who also chairs our investment committee. And any initiatives the business might be considering rolling out, it could be around NPS, it could be around marketing, it could be around new product development, will get tabled before the client advisory group. And these are typically people who have been captains of industry in their own right, or people who are very influential and who want to have a say about the way that the business is being run. They provide us with feedback, and that's our barometer in terms of whether or not something will be a success or otherwise if we wish to roll it out into the market.
Folks, any last questions? I'm sort of mindful that we're getting towards the end of the day. One last word from Matt.
Sorry. One thing I will say is that we do treat all of our clients as retail. So there are many operations out there who will treat clients in the high net worth, ultra high net worth. And I should clarify what I mean by that. By high net worth, we would categorise those as clients in the 3 to 5 million plus range. Ultra high net worth, 15 million plus. We treat every client across the board as a retail client because we don't strive to have two different business models. We don't want two sets of systems. We don't want two different ways of operating with our clients. The retail offering that we provide to our clients, and it comes back to what the gents were talking about earlier on, our advisors are really going into a deep fact-finding mission with these clients, and we think that really works as part of the relationship. Now, we might not hold all of the wealth, particularly at the ultra-high net worth end. I would suggest, I don't know the stats, but I'd say 1 out of 2 clients holds wealth independently from Findex to keep us honest, competitive tension, all of those sorts of things. But we treat them all as retail. We don't necessarily regard these clients as being any different from one another. At the end of the day, as I mentioned the other day, they've all got families with their own pressures and their own commitments and so on and so forth. So we tend to treat everybody the same as far as our back-end processes are concerned.
Up the back, just grab the microphone.
Was that driven due to the existing client base being regional and so spread out, having a lower number in those categories, or what percentage of your, I guess, existing accounts across the group fall into those two being above 3? Or like have you still got a mass amount of everyday Aussies and that's why you just want the same for everyone? Or
it will be primarily driven by that. I mean, we would have 400 family groups in excess of 3 to 5 and 50 family groups in excess of 15. So as a percentage of the overall, it's smaller than our traditional mass affluent retail base, but it is material as well when you look at the numbers. But because of the headcount probably being higher in that retail book, yes, that certainly is a driving factor.
Andy.
Yeah, I'm just interested in client referral, new clients. One of the comments in an earlier session was that referrals from accountants can often be combative, but obviously you've got an internal accounting structure. How would you describe sort of referrals from those accountants and referrals just more generally?
Yeah, even though and I've mentioned this the other day as well, Spiro, our former CEO, has always referred to the Crow acquisition as an arranged marriage, and arranged marriages don't always come together as well as you would like. So it took a number of years for us to really start the referral machinery working, and that's really just to get that level of trust running both ways from our accounting colleagues. But What we did to combat that in 2017, we formed what we are now calling the Findex Family Office. So all of our advisors are now housed in what we call multidisciplinary families. They're no longer in just siloed service line teams. So our financial planners will sit in a team with accounting and tax, business advisory, insurance, lending advisors, corporate finance advisors. So they are essentially the same team looking after a client. And purposefully our KPIs and so forth are structured to encourage that to happen as well. And that's just been going from strength to strength every year. So we're fortunate in that respect, and we recognise that that's the case.
Okay. Well, folks, I think we might wrap it up there. Can we give a round of applause
Thank
for
you, everyone.
Masterclass?
Thank you.